Most people trying to improve their retirement income are focused on the wrong problem. They're asking how to save more, earn more, or find better investments. And those things definitely matter. But there's another lever that most people never think to pull, one that doesn't require taking on more risk or changing a single investment. Unfortunately, it's taxes. Specifically, how much of your retirement income you actually get to keep after the taxes come out. I sat down recently with someone who had done everything right, saved consistently for decades, built a solid portfolio, made reasonable investment decisions throughout. Now, on paper, they're in very good shape. When we walked through how they plan to take income in retirement, a problem became very clear. They were on track to pay potentially tens of thousands of dollars of more tax per year than perhaps they really needed to. Not because of anything wrong with their investments, but because of how and when they were planning to take their money out. When I showed them what was happening, their reaction was immediate. Wait, I can actually control this? That's what they kept saying. And I said, sure, yes, you can. And that's exactly what we're going to walk you through today. So there are 5 things most people don't understand about taxes and retirement. And once you see them, the whole picture changes. So let's go through them one at a time. Number 1, understand what's actually creating your tax bill. So before you can manage taxes strategically, you need to understand what triggers them. Now, most people don't think carefully about this. They assume taxes are something that happens to them, which is a fixed cost they pay each year based on what comes in. But in retirement, the picture is a lot more nuanced than that. When you withdraw from a traditional IRA or a 401k, that money is taxed as ordinary income. Same with pension payments. Every dollar comes out and goes onto your tax return as if you earned it that year. But not all sources work that way. Withdrawals from a Roth IRA are generally tax-free, assuming you met certain conditions. Drawing on after-tax savings in the early years of retirement can keep your taxable income low. So that would be like a brokerage account, perhaps. The source of your income matters enormously, and most people have never mapped out which bucket they're drawing from and in what order and what that means for their tax bill year by year by year. So the question isn't just how much you need to withdraw, it's which account you pull from and at what point and what time. So that brings us to point number 2, the Social Security tax trap that most people walk into. So here's something that generally surprises most people when they first hear it. Your Social Security benefit could be taxed, not just partially, but potentially up to 85% of your benefit can become taxable income on your federal return. And it depends on what else is happening in your overall financial picture. Now, the IRS uses a calculation called provisional income to determine how much of your benefit is subject to tax. Now, that calculation includes your other income, half of your Social Security benefit, even things that generally are not taxed, like tax-exempt interest from municipal bonds. So what that means in practice is this. If you're withdrawing from pre-tax retirement accounts at the same time you're receiving Social Security, those withdrawals can push your provisional income above thresholds that trigger more taxation of your Social Security benefits. You could end up paying taxes on income you didn't realize was going to be taxed. The overall effect compounds across other areas of your plan. This could include things like health insurance premiums or Medicare premiums. Now, this isn't just some obscure edge case that we see just here and there. It's something that really catches a large number of retirees off guard when they begin retirement. And this is precisely because no one has walked them through understanding all of this in advance. So step 3, you can often control what tax bracket you're in. Now, it may not always work out perfectly, but there is one of the most underutilized ideas in retirement planning, and it's worth taking time to understand exactly what this looks like, and it's worth spending a moment on to go deeper. So we have a progressive tax system in the US. That means you don't pay one flat rate on all of your income. You pay different rates on different portions of it as it moves up through the various brackets. So only the income above each threshold gets taxed at a higher rate. And so what that creates for people who can plan carefully is perhaps an opportunity. In other words, in certain years, particularly in these early years, this early phase of retirement before Social Security begins, or maybe that started but before required minimum distributions begin, which is usually in your mid-70s at this point, their taxable income may be lower than it will be later down the road. So that could create this little special window of opportunity where you can make strategic moves at a relatively low tax cost. Roth conversions are one of the most common tools here. By converting a portion of pre-tax retirement savings to a Roth in a year, when your income is lower, you pay taxes now at the lower rate, and those funds grow tax-free from that point forward and also have no required minimum distribution or RMDs attached to them. So the alternative for people who don't plan this way is often a forced reckoning of income later. Perhaps these required distributions push you to significantly higher levels of income and brackets in your 70s, potentially bumping you into brackets that you had not thought about that maybe could have been avoided with earlier action. So this brings us to number 4, the strategies that most people never use beyond just these basic fundamentals. So there are a number of specific strategies that can meaningfully reduce overall lifetime income taxes. And unfortunately, most retirees are never introduced to these. So one could be capital gains are a good example here, where depending upon your income, you may qualify for a 0% rate on long-term capital gains. That's not a loophole, it's just how the tax code works. But it requires knowing your income picture well enough to take advantage of a deliberately lower tax option. Also, tax location, meaning which investments are held in certain accounts, perhaps a non-qualified brokerage account, an IRA that's pre-tax, or a Roth. Allocating those properly can also matter significantly. Again, holding tax inefficient assets in something like a tax advantaged account or tax efficient ones in a taxable account, these can help reduce this drag, this performance drag or tax drag across the portfolio and across time. Another idea would be capital loss harvesting or tax loss harvesting. This allows you to offset realized gains with losses, maybe even against a little bit of your ordinary income, and this helps reduce your tax bill in a given year. Now, also another option if you're over the age of 70 and a half is looking at qualified charitable distributions. These let you give directly from your IRA account to a qualified charity, a church, a 501c3. This also can help satisfy your required distribution without that amount counting as taxable income for that year. And for people who are still a few years away from Medicare eligibility, which is generally 65 years old, income-based healthcare planning under the Affordable Care Act, or ACA, can be meaningfully affected by how taxable income, and technically modified adjusted gross income, is managed year to year. So none of these is a magic solution on its own. Really, the real value comes from laying these all together in a coordinated way, guided by a clear picture of your income, your accounts, your timeline, and making an integrated decision for all of these. So number 5, timing is where most people lose the most ground. The most common mistake that I see isn't a bad strategy, it's simply a timing problem. Most people think about taxes once a year at filing time, somewhere between February and April every year. By then, most of the decisions that shaped your year's tax bill last year have already been made. There's very little left to do. So effective retirement tax planning works the other way around. It happens before retirement, in the years of retirement, during the year, while your income is often lower consistently throughout. The decisions made in those early years from which accounts to draw from, whether it's to do a Roth conversion, how to sequence in your income, can have an effect that compounds over decades to come. So again, there's often a window early in retirement where your taxable income is lower than it will be at any other point. That window is a real opportunity. People who plan for it deliberately can reduce their lifetime tax burden substantially. People who don't often find themselves in a much harder position once RMDs begin, and then their options will narrow. So the framework for smart retirement tax planning comes down really to just 3 main variables. So overall, when you look at the timing of when you take this income, the source of which account you pull from, and the amount that you're showing as overall taxable income. Get those 3 things right, coordinated with each other and with your Social Security strategy, your investment structure, and your long-term income needs overall, and the result isn't just a lower tax bill, it's a meaningfully higher standard of living in retirement from the same assets that you already have. And this is exactly what we build for clients at Cornerstone Wealth Planning. It's not just an investment strategy, but a coordinated plan that connects taxes, income, Social Security, and long term planning decisions into something that actually works together and is integrated for you. If you'd like to see what that looks like for your situation, there's a link in the description to schedule a free call. We'll walk you through your picture specifically and identify where the real opportunities are. Because retirement isn't just about what you've saved, it's about what you get to keep. So thanks for watching, and I'll see you in the next video.